Hello and welcome to CMS Forex News. I'm your market analyst Nick Nassad. Today is Wednesday, June 10, 2009. We begin in Japan, where the Corporate Goods Price Index, which measures the costs companies pay for energy and raw materials, slid 5.4% in May from a year earlier. It's the fastest pace that prices have dropped in 22 years. Price declines are set to continue as oil trades at lower levels than it did last year. If expectations are that these lower prices filter down into finished goods, companies and consumers may delay purchases while waiting for further discounts, continuing to pressure profits, which can result in higher layoffs. Orders for Japanese machinery fell again in April, though the 5.4% monthly decline was far below economists' expectations. The annual rate fell to negative 32.8%, and overall orders at 688 billion yen are the weakest in over 2 decades. Since this is an important measure of capital investment, it means that Japanese firms are not yet ready to begin investment spending, as their domestic recovery and demand is still very gradual. Australian consumer confidence jumped in June by the most in 22 years, as the economy was able to avoid falling into a recession by posting positive growth for the first quarter. Also, the significant stimulus from the government and lower interest rates are helping to boost consumer spending and borrowing. The sentiment index rose 12.7% from May to 100.1, the first time it has been above the 100 level since January of 2008. When the index is above 100, it means optimists outnumber pessimists. A second report from Australia showed the number of home loans for the April period increased 0.8%. Though that is a lower figure than was expected, it is still nevertheless the 7th month in a row that loans have increased. The Aussie-yen pair, fed by the weak data from Japan and the stronger consumer confidence from Australia, rose during the Asian session to retest its high from last week at the 79.60 area. The pair is now forming a triangle pattern with an upward sloping line of support and a horizontal line of resistance. Following its test of that resistance, the pair declined about 100 pips during the New York session. Risk appetite, which had been gaining overnight on increases in Asian and European stocks, faded as U.S. stocks fell on concerns about rising oil prices. The euro-dollar pair exhibited risk aversion in New York trading as it fell more than 200 pips from its intraday high near 1.4140. The level acted as a neckline for a head and shoulders formation from last week. Still, this move in favor of the greenback may be a period of retracement following the euro's rise to a new weekly high. The pair's decline stalled at the trend line established by connecting this week's lows near the 1.3920 level. The euro came under further pressure against the pound today, falling for a 4th straight session and wiping out all of its gains in this pair from last week. The euro pound set an intraday low today near 0.8550, which is a 6-month low, breaking below support from June 3rd. The pound was boosted by better than expected industrial production data. Manufacturing output in the UK rose by 0.2% in April, and with March's figure revised up to show a positive result, it was the 2nd month in a row that production grew. The annual rate, meanwhile, improved to show a negative 12.7% reading. In February, annual production was off 13.8%, which may have been the depth of the UK recession. Today's data is a sign that the year-long slump at factories may be stabilizing, and these figures show that production may not be a major drag on growth in the 2nd quarter. The UK trade gap in goods with the rest of the world widened in April. The deficit in goods rose to £7 billion from £6.5 billion, as exports rose 0.5%, but imports grew 2.5%. The figure overall was weaker than expected. A cheaper pound has helped boost exports to the nations in the European Union, but overall export growth seemed disappointing. The pound-dollar pair rose to a high of 1.6470 overnight, but its 3-day rally stalled there. The high amounted to a test of the 76.4% retracement level of the recent fall from June 3rd to June 7th, and may be a natural correction to the recent rally. The pair found support at 1.6240, which was the 50% retracement of the same Fibonacci level. Turning to the U.S. exports slid 2.3% in April, as February's positive reading has now been followed up by 2 months of losses. Imports fell 1.4%, but with the decline in exports outpacing the decline in imports, the U.S. trade balance for April, the U.S. trade deficit for April grew to $29.2 billion. The data reflects the weakness in the U.S.'s trading partners. In Canada, the trade balance there turned negative at 200 million Canadian dollars in April as exports fell 5.1%. Lower exports of industrial goods and materials, energy products, and machinery and equipment largely accounted for the decrease in overall exports. Imports, meanwhile, were down 1.5%. The US dollar-Canadian dollar pair rose 200 pips from its intraday low to test the 1.1160 area in New York afternoon trading. Despite further gains in oil prices, weaker US stocks increased risk aversion around the pair. Finally, we see the US dollar-Japanese yen pair, which gained, reclaiming its losses from yesterday and tested a line that was support, which now has turned to resistance. The 120 pip rally from today's low stalled near 98.40. Today's price action reflects Greenback's strength, but one must be cautious to make sure this isn't about a profit taking. We see the dollar's gains stall at the 98.90 level to start this week, so that level is now very important resistance. At 5 p.m. today, the Reserve Bank of New Zealand concluded its meeting, though it was too late for this broadcast. Other releases tonight include a private monthly measure of UK GDP, a revised version of Japan's first quarter growth figures, and employment data from Australia. There are no major releases scheduled for the European session. Tomorrow, the US posts data on retail sales, its weekly jobless claims, and a report on business inventories. Canada, meanwhile, will release a measure of factories in use, aka the capacity utilization rate. And that concludes our coverage of the Forex market for today. Thank you for joining us here at cmsfx.com, and happy trading.